And despite today's batch of strong earnings, our next guest says we are in the weakest earnings cycle in 55 years. He's Jeff Kleintop, Chief Market Strategist at LPL Financial. Jeff, welcome. Good to have you with us.
Thanks for having me.
You're not saying that this quarter's earnings are the weakest in 55 years. Explain to me what you are saying.
Yeah, take a look back. You can measure earnings cycles from either the trough of one cycle to the next or the peak from one cycle to the next. I'm looking back at this cycle from 27 quarters ago when it peaked, when the prior peak was back in the middle of 2007 to now. That growth rate is very poor. Earnings are only up about 21% over that period of time. Usually every other earnings cycle over the last 55 years, we've been up 60 to 70% at this point from the prior peak. This is the slowest in 55 years, not only because the trough was deeper, but because the momentum over the last few years has been much softer than we usually see at this point in the earnings cycle.
So, Jeff, what's the takeaway from this headline statistic you're giving us for investors? What do you want them to factor this in their investment choices? And what do you think of the latest batch of earnings? They have been pretty good this week so far.
Earnings are critical. We've seen valuations rise. Now we've got to see the earnings growth accelerate to justify those valuations. And that's why you're seeing many of those high flyers in the markets with those high PEs, price to earnings ratios, have been the ones that have had the biggest tumble here lately. Fortunately, I think earnings growth appears to be turning around. What we heard today, Coke had good things to say about growth in China. Intel had good things to say about business spending coming back. We heard good things from J&J about their outlook, and CSX talked about things thawing up after that deep winter freeze. All that's good news and should suggest that earnings growth will rebound and justify these valuations, help push the market higher.
But you do seem to be suggesting that for those companies where the earnings come in a little light, a little bit shy, that you think that the prices of some of those stocks have gotten beyond where they ought to be based on those earnings.
That's absolutely right, and we'll continue to see that punishing trend in the market for some of those high flyers that aren't meeting expectations. And look, you can see that with the type of volatility we're seeing even within a certain day in the market. You can see some of those stocks really getting taken out and hammered while others rally to near new highs. That's going to be a characteristic we continue to see.
All right, so how are you playing it that you're seeing a lot of these stocks just getting hammered? And I'm not just talking about the tech area. When you see these big sell-offs, how are you playing that? Are you buying on them? Are you sitting tight? What's your strategy?
Great question. I think this is an opportunity to buy. Many individual investors have only started to come back to the stock market based on money flows. So I think these are good times to buy. You want to take a look at those business spending oriented parts of the market. They're likely to see that rebound in pent up demand. I'm talking about industrials, and I'm talking about old technology, not the consumer, new tech, maybe in the NASDAQ, but other areas of old technology. Stocks like Intel, for example, or industries like semiconductors, industries like hardware, may be the places to be as business spending rebounds. That may be one of the surest bets in what's been a volatile year.
How much does Ukraine worry you, Jeff?
Not a whole lot, Tyler. I think if you look at what we've seen with Egypt, what we saw with Syria, is once the prospects for a military engagement by the U.S. appear to be well off the table, the markets tend to look past the geopolitical conflict, even if it accelerates to a potential civil war within the borders of that country. So I don't think this is going to be a major issue for the market, but certainly something to watch in the backdrop were it to accelerate and begin to involve some type of U.S. action.
All right, Jeff, thank you very much for being with us tonight. We appreciate your help.
My pleasure. Thanks very much.
Jeff Kleintop is the Chief Market Strategist at LPL Financial.